Kia ora koutou, inga iwi, inga mana, inga hoa mahi, tēnā koutou katoa. E mihi ana ki a koutou, kua tai mai ki te toko tēnei kaupapa. Ngā mihi nui ki Rui Mano, te kai kororo o te rā, tēnā koe. Ko Tim Hampton tōku ingoa, nau mai, haere mai, ki te tai ohanga. Good afternoon, everybody here in person and to those online. Welcome. I'm Tim Hampton, Director Economic System here at Treasury. It's wonderful to see a large number of people online and people here in person as well. This is another great instalment of the Treasury Guest Lecture Series, and particularly a very warm welcome to our presenter today, Rui Mano. Before I go into a bit more detail on Rui, let me run through a few quick health and safety for those of you who are here in the room with us. So in the event of a fire, please follow Treasury staff. So we've got group of us at the back, myself, and then there's a few speckled around. Follow us to the nearest exit and progress down the stairwell and evacuate the building. Do not use the lifts. In the event of an earthquake, please drop, cover and hold and stay in the building until instructed by a warden. Also bathrooms can be found, basically just head out the door and turn right straight ahead through the glass doors just beside the kitchenette. So moving on to Rui, I'm delighted to welcome Rui. He's the Deputy Division Chief at the Research Department of the IMF. So welcome, Rui. It's great to have you with us here in Wellington from Washington, and arriving in Wellington on Saturday and staying with us here through until Wednesday. You have absolutely lucked out in terms of gorgeous autumn Wellington weather. It's great to have you here sharing your expertise, not just in this session, but in the quite large number of extra meetings that you're having in this building, but also other buildings around Wellington. Rui previously worked in the Research, Asia Pacific Strategy, Policy and Review and Western Hemisphere departments at the IMF. He contributed to the fund's framework on external sector assessments, which we always engage very heavily in when they are drafted and published here on New Zealand. Contributed to several country teams and participated in the formulation and review of fund-wide policies. Rui's research institute's interests include exchange rate risk, foreign exchange intervention, monetary policy, and cross-border spillovers. Today, Rui is going to present an overview of the most recent World Economic Outlook, which was published just a few days ago. This document is one of the IMF's flagship reports, providing global growth forecasts and a summary of the state of the global economy, while highlighting the most important recent economic developments. Rui will provide an overview of the key messages of the WEO. He will dive a bit deeper into the role of housing and mortgage markets for monetary policy transmission as part of that's the key part of the outlook that he was involved in and is clearly of most interest to us here. As a small open economy, dependent on international connections, just having a great understanding of the global economic outlook and the risks is of particular importance to New Zealand. Without further ado, I'll just move on to a couple of logistics. Rui is going to present for about 40 minutes or so. Probably not take questions through that time, just given the hybrid nature, but we'll leave a good 40 minutes or so at the end for a good interactive panel session at the end. For those of you online, can you please use the Q&A function in Teams? So the Q&A function, not the chat function. That'll make it much easier for me to be able to navigate through that towards the end. So without further ado, I'll hand over to Rui. Thank you.
Thank you, Tim, for the warm welcome. I'm very happy to be here. Thank God I didn't arrive on Saturday from Washington D.C., so I'm well awake by now. I came from Australia, where we're doing also we did also some presentations. So today I'm presenting the World Economic Outlook, and this report really has. Let's see if this clicker works. Maybe let me click here. Yeah, it's good. So there's 4 parts to the report. There's always a first chapter in these reports that is about the global picture, the outlook, risks, and global policy priorities. And then there's what we call analytical chapters, which are deep dives into certain topics. And in this, for April, we have 3 analytical chapters. The first one is on monetary policy and housing markets, like Tim mentioned. This is the chapter that I was directly involved with. We also looked into medium-term growth and the slowdown in medium-term growth and what are the prospects for that. That's chapter 3. And then chapter 4, we looked at spillovers from G20 emerging markets. So kind of a revisit of the importance of G20 emerging markets for the world economy. So I'll give you it today. I was asked to speak mostly about chapter 1 and chapter 2. So the global outlook and monetary policy, housing markets. But I'm going to give you also a kind of an overview of the other chapters, maybe like 1 slide each, so that you kind of get the gist of it. So let's dive into it, starting with the first chapter, really the global picture. So here, I think this slide is kind of a summarizer of the chapter. And the message there is that growth, despite coming off of a pandemic, despite world wars around the world that unfortunately are happening, growth has been remarkably resilient. And at the same time, we've had a very rapid disinflation across many countries. So on the left, you can see headline inflation, which in 2022, as everybody knows here, got up to levels that had not been seen in some countries in a long time. And since then, we've seen rapid disinflation at the same time that growth has been quite resilient, and that's the chart on the right. And this is true both for advanced economies, but also emerging markets. So really kind of a positive picture, or more positive than we thought when we were making our projections just a year or so ago, or even a few months ago. The risks to this kind of outlook are now more balanced, in the sense that before, in the October 23 installment of our report, we thought that there were more downside risks than upside risks. So growth could surprise on the downside, and inflation could surprise on the upside more likely than the reverse. And now risks are more balanced, even though, of course, we're seeing that in the last few prints, and this is getting a lot of press attention, that inflation in some countries is actually surprising on the upside, which shows that there's some work still to be done for inflation to return to target. And then in terms of medium-term or policy priorities, what we're seeing is kind of a twofold. One is, for monetary policy, is extremely important to achieve the central bank target in the different countries, and so being extra vigilant about inflation potentially surprising on the upside, and making sure that monetary policy is calibrated with that in mind is very important. And number 2, what we're seeing is kind of a refocus, or kind of a shift of the mix between fiscal and monetary over the near term, where monetary has been, of course, tight, and fiscal, certainly during the pandemic, but also recently, a little bit looser. And we're seeing kind of a reversal of that, where fiscal should move towards a more conservative stance to rebuild fiscal buffers that were used during the pandemic in many countries, while monetary, depending on inflation, may have the chance to actually loosen if inflation permits. So kind of this is the overall picture. Well, let me guide you through a little bit, a few slides on what we saw recently and what we expect. So the first piece of the puzzle of why we've been surprised in terms of growth being better than what we were expecting is on the demand side. So there's been quite favorable developments on the demand side. So the chart on the left shows how government and private consumption have come above our expectations when we did our October 2022. So you can think of this as kind of the height of the inflation pressure period. And we made projections then, and now we're comparing to the projections that we have right now. And you can see that for government consumption, which is the blue, and for private consumption, which is the red, both of those in some countries and around the world have surprised on the upside. So that's been a boost to growth. The only exception to this is low-income countries where private consumption has actually been very weak, and I'll return to that. Second aspect is that, as we all know, during the pandemic, households saved quite a bit of extra funds in many countries, and they've been since then decumulating these savings. And so you have on the right a picture across several countries, and you can see that basically this is ongoing. This has supported the economic growth quite significantly as well. At the same time, we've had supply side favorable developments. So on the left, you have supply chain constraints that, of course, during the pandemic were extremely severe, and that even though we are talking about constraints in terms of Red Sea navigation, in terms of Panama Canal navigation because of flooding or rather droughts, there's been kind of a release of some of these constraints. And what that says is that if things were to favorably resolve themselves in either the Middle East, we could see even more upside to these supply chain constraints unwinding, and that would be a further boost to the disinflationary process and growth. There's another theme on the supply side, which I think will resonate here in New Zealand quite a bit, which is the strength of labor force participation, and particularly kind of the differential strength across domestic-born and foreign-born workers. So we've seen that in many countries, foreign-born workers have come into the labor market and really contributed to the strength of the economy. And the picture on the right shows you that this is true for the US and the Euro area. And I know it's true for many other countries, including Australia, and I assume also New Zealand. So strong demand, strong supply, steady growth. And really, when you look at our revisions from the last round, so in October 2023, what we see for 2024 is a revision of 0.25 percentage points in global growth, driven by mainly the US and China. So revisions in US and China growth. With the Euro area and other advanced economies, which would include New Zealand, the yellow bar there, a slight negative. So kind of other countries have been more or less where we expected them to be. The US and China have really surprised on the upside. In terms of the right chart, I think there's an important message to give here, which is so if you compare with where we're at right now versus what we expected before the pandemic. So think of growth projections just before the pandemic and where we're at right now. Most countries of course, still see the lower growth than was expected before the pandemic. But that lower growth is now kind of increasingly less negative. So that's the difference. So the red bars were our projections after the pandemic in 2022, where we were seeing a lot of scarring, so a lot of kind of medium-term growth weakness. And the current ones, which are the blues, which tend to be, for the world, certainly less negative. For the US, for example, we're already above what we expected before the pandemic. The only exception to this is really low-income countries, that where we see scarring still happening, and actually we now see even more scarring than in 2022. And this is a combination of different factors, which I'll go into in the next slide. So really, what we've seen is a decline in long-term or medium-term growth projections. So on the left, you can see the 5-year ahead growth projection for the world, advanced economies in blue, and emerging market and developing economies in red. And you can see that all of those are trending down, but more so for emerging market and developing economies. And that, of course, has very important implications for convergence. So lower income countries will have a tougher time converging towards higher income if these projections materialize. And this has to do with the scarring that we were just talking about. And some factors that play a role here are, one, the fiscal support that advanced economies and many emerging markets were really able to provide during COVID because they had fiscal space, and that in low-income countries, unfortunately, that support was not as effective and as large, just because they had less room to maneuver. Number two is that we've had very significant supply side shocks. So essentially, the energy shock during the war, in the beginning of the war in Ukraine and subsequent months, and also food prices have been quite elevated. Those have a particular strong effect on low-income countries. And so there's really a little bit of divergence. So it's not only steady but slower growth, but also steady and more divergent growth. So in terms of risks, we have, as I mentioned, broadly balanced risks. There's risks on the upside that have to do with different factors, including we have a year with a record number of elections. So somebody counted the number of elections that we have in 2024 versus elections in other years, and 2024 is the record year for a long time in number of elections. And so that may support growth, just because around elections there tends to be a fiscal boost. Then there's, as I mentioned, supply side restrictions could be easier. So that's kind of, we'll leave that to the upside. And certainly if some of the issues that are, hampering supply chain kind of free flow will resolve themselves, that will be a boost to growth and lower inflation, and of course help with monetary policy returning to target. And then productivity that could be boosted because of artificial intelligence. So we're leaving that mostly as kind of an upside risk. And on the downside, there's some of the familiar themes that we've had from the past. We have commodity price spikes due to regional conflicts that could emerge or could strengthen. China's recovery, which is in train, could falter. And I'll highlight also geoeconomic fragmentation intensifying as another risk. So I'll give you a couple of very quick thoughts on these. I chose one upside risk, one downside risk, just to give you guys a feel for these. So one is on AI. Of course, the market pricing in certainly in the U.S. has been quite ebullient on AI and kind of bullish on the prospects of AI. We're being more cautious at the IMF, and we think that there's great promise, but there's still also a lot that we need to see before putting it in the baseline. Of course, one thing that's well known by now is that many cognitive skills that are required for many jobs are now can be performed with AI at reasonable levels of expertise. But really, and I'll focus now on the chart on the right, which is not from the World Economic Outlook. It's from a report that we put out, which if you're interested in the impact of artificial intelligence on growth, I really recommend that you take a look at that report, which is cited there, where we took a deep dive on which countries, which sectors, which occupations are exposed to AI. And there what we found, so the chart here shows kind of two dimensions that you should think about when deciding whether AI will mean something important. So one is, to what extent are occupations exposed to AI? So if you look at the tasks of a given occupation, is there overlap with the tasks that AI can now perform? So that's the x-axis. So you can be very exposed to AI or not very exposed to AI. Then on the y-axis is the degree of complementarity of substitution of AI with a human doing that job. So AI can have overlap with tasks that you perform, but it could be complementary to what you do rather than substitute. But in some instances, it could also substitute. So really, when you think about this diagram, you have professions, for example, economists, that where we have high overlap with AI, and kind of a medium level of complementarity or substitution, and maybe telemarketers are more kind of at risk of substitution. So if you think about it in this framework, there's essentially what we came out with was that advanced economies are both more exposed to AI, but also kind of better ready to take advantage of it because some of these complementarities are also there. So it's kind of a rich picture that really puts a question on the reallocation across jobs, et cetera, and this potential dislocation. Okay. The other risk is a downside that I wanted to focus on, or at least give you some sense of, is geoeconomic fragmentation risk. So here we asked, there's a box in chapter 1 where we asked the following question: can we see already in trade data some geoeconomic fragmentation? So what we did here was we split countries in hypothetical blocks based on the March 2nd, 2022 UN vote on Ukraine. And then we looked at what happened to trade either within these blocks or across these blocks. And what you see here is that trade between blocks has fallen much more so than trade within blocks, meaning that we're already potentially seeing some geoeconomic fragmentation. And this is particularly so for strategic sectors, which are the red bars. So there could be more coming, and this is definitely a very serious downside risk that we consider at the fund. In terms of policy priorities, I've already given you the headline messages on the smooth landing for monetary policy and rebuilding fiscal buffers. I'll also mention that, of course, cross-border cooperation, especially we just came from a slide that was about geoeconomic fragmentation, is extremely important, and of course a very important area of concern for the fund. So this was chapter 1, and little bit over 20 minutes I have. Let me give you a quick overview of chapter 3, actually. So let me jump over chapter 2, give you a quick overview of chapter 3, and then chapter 4, and then return to chapter 2. We'll see how much time we have, and then we'll do a deeper dive. So chapter 3, because it flows better with chapter 1, is on medium-term growth and why it has come down. That's the question that chapter 3 asks. So here I'll give you two pictures. One is just a growth decomposition of gross domestic product. So you can decompose using the production function approach GDP into its inputs, which are labor and capital, and then total factor productivity, or TFP, which is just the way you use inputs to produce things. And what you can see on the left is that over the last few years, we've seen a decline of growth a real GDP growth. And really, where that has come from is a decline, most importantly, of total factor productivity. So kind of the way we use inputs. There's been somewhat of a decline also of labor contribution and investment. Now, if we look forward, something that we've already seen happening and we will see much more so going forward is really declines in working age population, kind of age as a reflection of aging. And this is affecting most economies in the world, really. So if you look at the right chart, what we have is the working age population growth in 2008 in the x-axis, and then on the y-axis, the same working age population growth, but in right now in 2021. And what you can see is that most countries are to the right of the 45-degree line, meaning that we now have lower working age population growth than before. And really, this is a trend that will continue in most countries. And there's a few exceptions, which are low-income countries, which are the green bubbles towards the right of the chart. And here, I think the chapter highlights kind of the challenge, which is you have ample capital and innovation and total and high efficiency in advanced economies, and you have labor in lower income countries. So how do you bridge this gap? There's different ways that you can bridge that gap. Of course, migration is one way, but the other way is also that there's investments, foreign direct investment that's done in lower income countries to bring capital and innovation into countries that actually have young populations and growing working age population. So the chapter discusses that a little bit. And just to give you one sense, there's a simulation that's done, or kind of an exercise, a scenario exercise that's done in the chapter that says that if we extrapolate some of the trends that we have seen and kind of using judgment on what we could expect in the next to the end of the decade, we would see a decline by 1 percentage point of medium-term growth. So medium-term growth could be below 3%, 2.8, compared to its pre-pandemic level, which was 3.8. So kind of a call for more action if we were going to see higher medium-term growth. So that's chapter 3. Chapter 4, as I mentioned, looks at emerging markets, G20 emerging markets, so large emerging markets, and their importance for the global economy. And the picture on the left just shows something that I think everybody knows intuitively, which is that these G20 emerging markets have really grown in terms of their share of the global economy. In this case, we're showing trade. So their share of trade has really reached now about a quarter of world trade. So they're very significant players. And if you do a modeling analysis of thinking about a slowdown in these G20 emerging markets and what that would mean for other countries, including advanced economies and other emerging markets, what we find is that while in 2000 they were still kind of not as consequential, that in 2018 now their spillovers are quite significant. Certainly from China, you see the yellow bar is at least as large as the one for as the U.S., which is the diamond. And other countries like India and other G20 EMs are also becoming very relevant in terms of spillover. So you can certainly a slowdown in China, as we all know, has repercussions for many countries. But what we're seeing here is that also the other G20 EMs are increasingly contributing to world growth. So that's chapter 4. So now I'll go back and discuss chapter 2 in the next 15 minutes, and then we'll open for questions. And I'm happy to, there's a lot of details. So these chapters have, like, I don't know, 40 people behind them directly, and then indirectly, basically the whole fund, because we have teams for every single country that you engage with for New Zealand. So we have teams in every single country that contribute to these projections and these analyses. So it's really a very big team effort, and it's hard to do justice in this in this time frame, but I'm happy to go into any area that interests you more in the discussion. So chapter 2 is about monetary policy and how it transmits through housing and mortgage markets. So first, just to say that when thinking about the transmission of monetary policy, what we have in mind for this chapter is really how a change in monetary policy rates changes economic activity and also house prices. That's what we're going to call transmission of monetary policy. And actually, we're going to be very much focused on households, so consumption of households, less so on firm behavior or other kind of transmission. So the context, I think, is familiar to everybody. We've had a quite remarkable period for monetary policy in the last 2-3 years. So the chart on the left shows you the change in monetary policy. So reds are tightening of monetary policy. We're just counting how many numbers of what's the number of tightenings that we've seen in each quarter, and the blues are loosening movements, so kind of reduction of monetary policy rates. And you can see that in the last 2-3 years, we have both in terms of the gray, in terms of the synchronization of monetary policy tightening, something that we have not seen in many decades, as I think everybody will recognize. But what is maybe even more interesting is that despite the degree to which we've had this monetary policy tightening that is fairly comparable across countries, we have very different experiences across countries. So some countries, and here we're showing nominal house prices and real consumption as measured from, you start with what was consumption, what was house prices just before you started tightening monetary policy for each country, and then you look at where they're at right now. So from the beginning of the tightening to where we're at right now. And you can see that there's a third of countries that have negative nominal house price growth, which is basically that blue, the part of the blue whisker that goes below zero. And that's very rare. It's extremely rare to have 30% of countries with negative nominal house price growth. And there's some countries that have very weak nominal house prices and also very weak consumption growth. For example, we put here example is Sweden and Germany. There's on the other side, there's countries that have had very strong nominal house price growth and also strong consumption growth. And the examples we're giving are Hungary and Colombia. And then you see that US is kind of straddling these, both have been quite stable. And I put New Zealand here just for good measure so that you can compare to other countries. And you can see that New Zealand, and you'll know this well, nominal house prices actually pulled down more than any other country in our sample since the beginning of the tightening. But consumption has been somewhat steady. Of course, on the back of this is kind of the long-term developments in house prices. And there, I think you'll also recognize kind of the figure for New Zealand, where we had very, very strong growth when the pandemic hit in nominal house prices. So that pullback that we were seeing in the other chart is really from these extraordinary levels that we saw just during the pandemic. And this is a pattern that we see in many countries, not all, but certainly for New Zealand, it's a very pronounced pattern. Now, commercial real estate, I will skip this. I'm happy to talk more about it. It's not a focus of our chapter, but there's a lot that could be said there as well. So the chapter is really asking 3 questions. So the first question is, if I need to think about monetary policy transmission and housing markets, conceptually, how does monetary policy transmission work through these markets? Okay, and so it's basically like, what is the conceptual framework I should use to think about this? The second is, if I believe or if I assume that housing markets and mortgage markets are important for monetary policy transmission, and I know that these vary tremendously across countries, then that has to mean that monetary policy transmission is going to be very different across countries. And that's what we're going to ask and then find. And then the third part is, many people have wondered, given the tightening that we saw of monetary policy, and in some countries kind of robust growth like we saw in chapter 1, and kind of steady even household consumption, whether monetary policy is now weaker than it used to be. Transmission is weaker than it used to be. So we're going to look at these mortgage and housing market characteristics and see where they moved in the last few years to say whether they could help understand whether monetary policy transmission is actually weakened or not. And we're finding that in many countries, indeed, these characteristics moved in the direction that would render monetary policy transmission weaker. Okay, so these are the questions, and I'll give you also the findings so that you kind of, now that you understand where we're trying to go, you crystallize these, and then we'll go over some details. So on the cross-country heterogeneity, what we find is that several characteristics of mortgage finance and housing markets matter a great deal for monetary policy transmission, the strength and the delay, kind of the lags of monetary policy transmission. We looked at 3 mortgage finance characteristics, which are the degree to which you're allowed to leverage when you buy a house, and that's measured by these regulatory LTV limits. So if you have looser limits, you allowed more leverage, then monetary policy is going to transmit more strongly. Same for debt. Is basically same idea. If you have a country that has more household debt, households are more indebted, then the same movement of monetary policy will have greater effects on the activity. The last one on mortgage finance characteristics is about the degree of mortgage payment fixation. So some countries have essentially fixed payments, and so mortgage payments of households have not changed that much since we've had this tightening of monetary policy. In other countries that have adjustable rate mortgages are much more prevalent. And so, of course, in countries with more adjustable rate mortgages, monetary policy transmits more strongly. And that's what we find. And then in terms of housing markets, we looked at within country regional housing markets, and we looked at 2 characteristics. One was housing supply constraints. So to the extent to which there's a region within a country that is more constrained in terms of their housing supply, we see monetary policy actually transmitting more strongly in those regions versus the regions that are not constrained. And the same for overvaluation. So regions that have pre-existing overvaluation in their housing markets also tend to react more to monetary policy. So that's the 5 characteristics that we explored. And then in terms of the changes over time, what we saw is that in many countries, we saw a direction towards weakening of monetary policy transmission. In many countries, LTV, so loan-to-value limits, have been tightened since the global financial crisis. The share of fixed-rate mortgages has risen in many, many countries over the same period. And during COVID, several countries saw population move from high-density urban areas to less dense urban areas, which would mean that essentially supply constraints, just by a compositional effect, would be lessened on average. And so that would also render monetary policy transmission weaker. But there's really a very country-specific picture here. So I'll give you some more details. So a quick word on the channels, because I haven't mentioned them at all. So the diagram here is a stylized version of kind of how to think about the transmission of monetary policy. So on the top, you have the change in policy rates to household consumption and residential investment, which are on the bottom. And so these can go through different channels. The first channel is kind of what the literature calls the cash flow channel, which is a very direct channel. It's basically if you have adjustable rate mortgages and they tend to, the indexation of those mortgages tends to vary with more monetary policy rates, then households will get a direct channel of monetary policy into their budget, into their monthly budgets by this. And so if they cannot borrow, for example, there's a tightening of monetary policy, their mortgage interest rates, their mortgage payments go up. If they cannot borrow to supplement their income, or they cannot get a greater income, then they'll have to adjust consumption of something else And so that's a very direct channel, channel number one. Other channels go through either house prices or credit. So, if interest rates are higher, that means that you may form and basically because asset prices or housing is a very long-term asset, interest rates through just valuation have an effect on more housing prices. And so house prices, both directly from monetary policy being tighter or by shifting expectations by monetary policy shifting expectations of households relative to the future house price, will affect house prices, which then may affect consumption. And this is just the wealth effect that has been documented in the literature. It can also go through credit. Basically, housing is used as collateral. Therefore, the price of houses matters for the extent to which you can get new credit. And so that is another channel. I'll keep it brief now. I'll move on and tell you a little bit about, let me show you a picture on how these mortgage market characteristics vary across countries. So here we have the three characteristics that we focused on. One was limits on loan to value when you're buying a house. The middle one is household debt, the extent to which there's debt in each economy, and fixed rate mortgages, the extent to which there's a high share of fixed rate mortgages. And then the diamonds are like post GFC, just after the GFC, where each one of these variables stayed at or was at. And the bars are the latest print that we have, which is end 2022 for all these countries. And what you can see, what you can see is that, for example, I'll take an example, and since we're here, let me take New Zealand. So for New Zealand, loan to value ratios were tightened quite a bit after the GFC. So you can see that basically you went from kind of almost allowing you to borrow 100% of the value of your house to a level that looks more like 70% today. So that would move monetary policy to have a weaker transmission, for example. Then household debt, we have actually is a mixed picture where some countries increase their household, the extent to which the household debt is high, whereas some others decrease their household debt. And then with regards to fixed rate mortgages, what you see is that for most countries, really like the vast majority of countries have moved towards more fixed rate mortgages, but to different extents, right? So some countries like the US, fixed rate mortgages are more than 90% of total mortgages. In other countries, say here in New Zealand, they're more like a third of total mortgages. And this is measuring kind of fixed rate mortgages in the next 12 months. So it's kind of a very kind of favorable definition of fixed rate mortgages. Okay. In the 3 minutes I have left, let me show you kind of a picture that summarizes the whole chapter across countries. I have the 5 characteristics that I told you about that matter, that we found matter. The extent to which mortgages have fixed rates, the limits to leverage, the debt of households, supply constraints in housing markets, overvaluation in housing markets. So that's the columns. And then what we did here was just color-coded countries in the cross-section, essentially in the distribution of these variables right now. So if you have a lot of adjustable rate mortgages compared to other countries, like Australia does, for example, which is the top line, then you're going to have a very kind of a dark red, meaning that transmission of monetary policy, because of that factor alone, is going to be stronger than countries that have more fixed rate mortgages like the US or the Netherlands. And so we did that for each one of these characteristics, and you can see, and then finally we sorted and we counted reds. So it's not a very scientific aggregation that we're doing here, because it would be very hard to aggregate these characteristics. Kind of, you'd need a model, and it's I think beyond even academic, the current academic status. But we just count out the reds, and we say that if you're towards the top of the table, then you have strong channels of monetary policy transmission through housing and mortgage markets. And you can see that New Zealand is towards the top of the table, and mainly because of supply constraints, which seem to be quite important here compared to other countries, and also the high degree of household debt. In terms of fixed rate mortgages, maybe there's a little bit more fixed rate mortgages than in Australia, for example, but much less than in some other countries. So that is also a characteristic that makes monetary policy transmit strongly. And then in terms of over time, what we find is that when you look at these characteristics and where they moved, that many of them moved towards making monetary policy transmission weaker. So that's the blues. I'm not going to explain everything that's here, but essentially, if you see a lot of blues in this map, and where you see those blues is where the characteristic in question moved towards making monetary policy transmission weaker. And you can see that in many countries, there's a lot of blue. So indeed, at least there's a delay of monetary policy transmission. I'll close with this slide, which is the policy implications of this analysis. So I think there's several policy implications that you want to think about. One is for monetary policy, of course, and this is well known. I mean, the Reserve Bank knows this very well, that the kind of housing markets, mortgage markets are important to think about the transmission of monetary policy. You need to know your markets well to understand how your monetary policy will transmit. So this is just highlighting that with data from from across countries, which sometimes central banks are more focused, of course, and they should be on their own country. So this is giving a global picture of that. Then if transmission, that's my own thing of, yep. If transmission is found to be strong, for example, so we're here saying that New Zealand stands out partially in this cross-country, in this picture across countries, because it has strong channels of strong housing channels of monetary policy transmission. So that means that you want to be very mindful of these, and of course, monitor housing markets carefully and vulnerabilities arising quickly, because once you start seeing effects, they'll materialize quite quickly, right? In countries where, and many countries have moved towards weaker monetary policy transmission, then it could be natural to think that means you can tighten more. For example, you can be more preemptive when you start seeing price pressures arising that will be a challenge to meeting your target. Central banks could tighten earlier, and that is true, but there's a wrinkle here, a nuance, which is you saw that a main characteristic that moved towards making monetary policy weaker was the degree to which there's now more fixed rate mortgages. But in many countries, and I think New Zealand is one of them, these fixed rate mortgages are not fixed forever. So they're fixed, there's a short fixation period that runs off. And so what that means is that you really have to pay attention to these fixation periods runoffs, because as they will start running off, then households will very quickly start feeling the pinch. And so monetary policy, which at a given point may seem weak, could then become much stronger quickly. And so, of course, this is a risk for high for long, which now many people are talking about, given the prints that we've seen in inflation in many countries, whether we're going to have high for long interest rates. This is a consideration that, of course, central banks would need to take into account when thinking about that. And then the final thing to say on policy implications is that it's more for macroprudential policies and borrow in housing markets, so borrower-based macroprudential policy. So you are well aware that countries, especially after the global financial crisis, deployed several rounds of macroprudential policies to essentially limit vulnerabilities and downside risks in many economies. LTV limits, which we've studied, are one example of such policies. And what we find, because we find that a tighter macroprudential policy on housing kind of weakens monetary policy, you could think, oh, okay, but that doesn't sound good. But it's actually not at all the way it should be read. So it's actually a nuance that is important to mention, which is by making sure if you have macroprudential policies in place, you're essentially limiting downside risks and the extent to which you have vulnerable households. By doing that, you allow monetary policy to actually be more forceful, because monetary policy can focus on aggregate demand management without fear of precipitating a financial crisis. So actually, it's a very nuanced picture, and it's not at all saying that macroprudential policies should not be pursued. On the contrary, we're actually one thing that we learned, or that we knew, but that was reinforced, was that macroprudential policies, the LTV limits are very widely used in many countries, but other types of macroprudential policies that are borrower-based in housing markets, like debt service to income limits, debt to income limits, are really not very prevalent. And so we're advising countries to deploy them where they're not in place, because they tend to be quite good kind of modulators of risk, even better than sometimes than LTVs. So that's the run through. Happy to get your questions and get a discussion going.
Thank you, Rui. Is that working? Is that good? Can they hear me online? Yep, cool. Hey, thank you very much for that, Rui. As you said, the WEO is a very extensive, set of documents, and there's just so many different channels that we can go into. So for those online, just a reminder, put your questions into the Q&A slot, and we'll pick those up as they come through. Really appreciated the presentation today, and also the charts. Like, often here in the New Zealand context, we see all this international cross-country stuff, and we go, I wonder where New Zealand sits on that chart. And it was really good to see you draw that out. But also, what was clear in your presentation is you actually had thought about it a lot, not just where New Zealand sits, but actually why it sits there and things. Just one question for me on that last bit. You were talking about the macroprudential levers, and I was hearing that sort of presented as kind of like a set and forget macroprudential. Does the use of them through the cycle, so varying them through the cycle, sort of, how do you think about that in the context of, monetary policy effectiveness? And it's particularly relevant in New Zealand, where it's the same organisation that has both of those levers.
Thank you. Yeah. So we didn't look at that, but here there's two things to say. So first, I mean, the fund has maybe you could call it a vanilla view of macroprudential policy. So macroprudential policies are to guard against financial stability risks. That's their target. They're not for aggregate demand management. And so they should be adjusted based on financial stability risks. So if financial stability risks are rising over a cycle, which they may be, then they should be tightened. But of course, there is an interplay and a complementarity or substitution with monetary policy that one needs to be very mindful of. So if when moving macroprudential across the cycle, one needs to also have in mind that you're not that you're fitting in the policy toolkit, and you're not undoing other macro policies at the same time. So that's what I would say. There's actually work that's being done now at the fund on this question. So hopefully in a few months I'll have more to say on this, because my division is actually it's a macro financial division. So we do a lot of work on these topics, and we're right now thinking exactly with colleagues across the fund on how to think about price stability versus financial stability, macro-pru monetary policy, and revisit that thinking.
And I'm sure there'll be plenty of discussion on that tomorrow when you go across to the road to the Reserve Bank. Question in the room, yeah. Just pass the microphone over.
Thank you. I guess I have quite a few questions. So first, you mentioned the overvaluation being one of the characteristics. So how do you define overvaluation, or actually like how do you come to a view that a certain place is the value of the property is over its intrinsic value? And also, how does that factor actually interrelate with the loan to value factor? Because I mean, if the value is overvalued, then loan to value, even if it's a low percentage, is still kind of like comparing to the intrinsic value, maybe high. So that's question one. And I guess the second question being, so you also mentioned that the fixed period of a mortgage, like for example in United States, I still remember like when I'm buying a property in the United States, 25-year long term, 25-year fixed rate. So basically, I get fixed all through the long term, where when the interest rate lowered, I can just refinance and keep the lower rate forever. But it's not the case for, I guess, for most of the country. So does that factor actually come into your consideration regarding the fixed rate? Like, I think the periods might be quite important, because fixing 30 years versus fixing 2 years might be a huge difference, because if I'm fixing only 2 years, I may need to prepare for potential increases in 2 years' time. Yeah, that's that. I think I still have another question. Yeah, third question. Sorry, sorry for dumping it into you all at once. Third question being, so do you see, like, because this is pretty much focused on the monetary policy, do you see the interrelationship between the fiscal policy versus the monetary policy, where, say, fiscal policy might also have an impact on, say, for example, the country has been investing heavily into the housing market to provide more supply into the into the market, versus in some other cases it might be building more infrastructure, or the fiscal policy might be more towards the transfer payments sides. So does that actually have a huge impact on the effectiveness of the monetary policy? I think that's all. 3 questions. Sorry.
No, thank you. Questions are good. So I'll start with the last one, and then I'll take so the last one is easy because we didn't look at that. We didn't look at the extent to which fiscal policy plays a role here, and I think your question is very interesting in terms of the types of fiscal policy that one could deploy. I think it's a fascinating question. I don't have an answer for it. I'm sorry. On the other two. So first on the fixed rate, maybe I'll really take them in the order, the reverse order that you asked. Fixed rate mortgages. So first, it's actually 30 years. So the standard in the U.S. is 30-year fixed. Is the most prevalent type of mortgage in the U.S. I don't think it would affect much the analysis here, because we're really looking at business cycle frequencies. So I didn't show you all of this, so you wouldn't know unless you read it, but we looked at the effects of monetary policy up to 2 years after the tightening. Okay, so it's basically based on monetary policy surprises. If you have a surprise tightening, what happens in the quarter subsequent to that tightening? I mean, a picture that is something like this, for example, and you have basically quarters are on the x-axis, so you're looking up until 2 years. So what matters is whether there's fixation up to 2 years or not whether it goes to 30 years. So having 5 years fixation now, residual fixation versus 30 is exactly the same for these pictures. Yeah. Okay, so then your first question on overvaluation. So of course, this is a very complicated question. So here, our approach was not to try to do like real-time measures of overvaluation or valuation, because of course, you need quite complicated models and probably country-specific models to think about that. So what we did was very simple and maybe unsatisfactory for you. What we did was we have regions. So this analysis is based on, it's actually the one that's on the slide. It's based on 10 countries. So we, instead of looking at country level, so country time variables, which is the mortgage market characteristics, we do them at the country time level. For housing market characteristics, the oversupply, the constrained supply and the overvaluation, we do them at the regional level for within countries. So we still run a panel. So we have 10 countries, the average experience of these 10 countries, but we're focusing on the difference between regions within the country. So for the same tightening that happened in a country like the US, do certain areas with a certain characteristic react more than other areas within the US, okay, to the same tightening, okay? So that, just to give you a picture of how we were doing this. And so overvaluation, how do we define it? We have, for the US metro area, house prices. And what we do is a very simple longer run average of the house prices to income. So house price to income ratio. You take the long-term average, and then you see who is way above. So we're doing the top 25th percentile of house price above your long-term average. So you may say maybe that's not a good measure of overvaluation. We think at least in the cross-section within a country, it lines up with different measures that people have put forward for overvaluation of housing markets.
Another question in the room, and then I'll do a couple online.
When focusing on those 5 explanatory variables, the 5 columns in your color chart, did you consider some other explanations that could be relevant and discarded them on empirical grounds? And maybe done some forward thinking what other factors could start influencing the transmission of the monetary policy? Because in Wellington specifically, you have this thing around house insurance that grows much faster than inflation. Because of the climate and earthquake risks, some houses may become uninsurable or the premium can go through the roof. So all of a sudden the insurance is not just by the by, but quite a big chunk of your annual payments on the mortgage. And that obviously would interfere with the transmission mechanism. So, basically the question is whether you looked around and perhaps forward to these kind of new risks.
So you have like kind of two parts of your question. So the first part is, did we look at other characteristics and discard them? So we looked at a few other things. For example, in the literature, there's people who found an effect of home ownership rates. So countries with higher home ownership rate, people are more reliant on housing wealth, and therefore the wealth effect, the wealth channel, should be stronger. We did not find that. We're looking at a bigger cross-country sample than any academic study that has been done on this issue. Typically, they stop with the European countries and maybe a few, maybe US, Canada, a few others. We didn't find that variable to be important, but we found actually that home ownership rates with mortgages to be important. So the fact that you own a house outright and you have no debt on that house doesn't seem to make you very responsive to changes in the wealth of that house. But if you have debt, then it is a different matter. So that to us suggests that, for example, the pure wealth channel is not very strong, but channels that go through collateral, for example, or through adjustable rate mortgages and things like that, those are more important. So that's on your first part. Second, you mentioned, I want to understand a little bit better your question, so I'll put kind of 2 hypotheses to try to understand it. One is, housing, say like my monthly payment for my place, for my house, I have to pay insurance, I have to pay taxes, and I pay the mortgage interest payments and principal. So that's what I pay every month. And one way to understand your question is, imagine in a world where this payment, this kind of amount, is the proportion that is not interest rate sensitive, because insurance in my mind is not interest rate sensitive, is larger. That would be something that goes against transmission of monetary policy, right? So so if insurance is now a much bigger share of households' housing spending, then of course monetary policy is not having as much effect on your housing spending, is only having an effect on your mortgage payments, which are small. So that was one way I could understand your question. And I don't know if that's what you had in mind, because the other way to think about it is, since these insurance, and I'm literally taking like these facts from you. I don't have any. You guys know New Zealand. So if insurance payments are going up because of climate issues and others, then these are just long run factors. They have nothing to do with monetary policy, and so one could almost think that they would not impact the transmission of monetary policy, except for what I just said before. So to some extent, they're just something that's happening that will, depress consumption, all else equal, in general, on average, without regard to the monetary policy cycle. I don't know if this is.
Thanks for that. Got a question here from Lloyd Spence online saying, any idea why New Zealand banks have taken a harder line on LTVs, going from the 100% in 2001 to where they are now, as opposed to other countries? And is this related to banks' risk assessment? Now, my sense is it's a combination of, the regulator having told the banks to do that. Do you think your results change whether it's, commercial banks doing their own thing as opposed to the regulator telling them to tighten?
Yep. So first, to be clear of what we're looking at there, what I showed you there, that is entirely regulatory. There's nothing about banks' choices in those variables that the LTV variable that I was showing you. It's the regulatory LTV limit in New Zealand. It's entirely not up to banks to decide that. I hope not. So that's what we looked at. Why did we look at that and not LTVs that are actually given to people? Because of course, if that's going to be the max LTV, people typically will have lower LTVs than that, right? So there's two reasons for that. The first is that we want to think about variables. So just kind of maybe a geeky point, but you want to think about conditions in housing or mortgage market that are insensitive to monetary policy. So essentially, you want to think about these characteristics as being somewhat set, and then monetary policy does something, and then you look at what happens given that monetary policy. You want them to be exogenous. If they're endogenous, then you have a problem in identifying these effects, because not only you're looking at the effect of monetary policy on consumption, but also it changed the characteristic, which then itself may affect consumption. So when you look at the LTVs that actually banks offer, they are, one would assume they're relatively responsive to monetary policy, right? So you could think of different reasons why that is, but for example, if monetary policy is looser, then banks, all else equal, may accept more leverage from a household, right? And so you don't want to use those LTVs that are offered by banks. So that's kind of the geeky, kind of technical reason. But there's also a policy reason or a policy interpretation that we want to draw, which is if you want to say something about the stance of macroprudential policy and how it affects monetary policy, then you have to use the regulatory limits and not the limits that the banks set themselves. So there's also a policy implication or policy interpretation that we want to give by using these regulatory limits.
No, that's very useful, and yeah, hopefully that answers your question, Lloyd. A question here from Hillary, and it comes back to that point around sort of the definition of floating rate. Compared to the US, New Zealand is all floating rate, and so you've compared to Australia though, where very much a fixed rate model. Using that 12-month cutoff is if you moved that 6 months later, how New Zealand is ranked could change quite considerably. Like, did you do any sensitivity around that 12-month point?
So actually, this is a great opportunity for me to dive a little deeper on the chapter. Constructing that picture that you saw on the fixed rate and the extent to which they are prevalent or not across countries was extremely hard to construct. And if you've seen a picture like that, which you may have seen for a few countries, normally they're done on the flow of mortgages. So typically people look at like the flow of mortgages in a year and they say, this is the share of fixed rate mortgages in this year. And then they compare across countries and, oh, like New Zealand is low and US is high based on new mortgages. But what matters for monetary policy transmission is not the extent to which there's new mortgages that are adjustable versus fixed in a given year, is to the extent that the stock of mortgages is fixed versus variable. And that is surprisingly hard to find for many countries. For New Zealand, thank God this data is actually publicly available. But for many countries, we actually had to reach out to country authorities. And we did a huge work of reaching out to country authorities, to the central banks, get this data. And so, unfortunately, we had to kind of decide a definition that we could collect data for. And we went for this definition of 12 months because it seemed to be the one where we could get the best coverage for. So now that I've said all of that, to answer your question, we did not do sensitivity. We would love to do sensitivity. Please give us the data for that.
Any more questions in the room? Ben?
Can I go back off the housing chapter into the World Economic Outlook, if that's all right? I guess one of the things that you said right at the outset was, where countries have shifted into a tightening cycle, and the fiscal policy had been run a lot looser in the past, and it's now moving to tightening. And I guess that has been a challenge, and different countries have done better or worse at moving from that, transitioning from loose to tight fiscal policy. And for some countries, it's been a while since they've had to do that. I guess in the context of quite a tone shift from the IMF itself in terms of policy between 2020, when there was strong encouragement from the fund to run loose fiscal policy, and real concerns from the fund about whether in aggregate at a global level whether fiscal policy was going to be able to be run loose enough. Policymakers have had to be very nimble, and so I guess the question is, have you seen, or does the fund have views on how well countries have done at making that transition, and B, what sort of countries have done better at going from very loose to very tight in a relatively short time frame, and is there something we can learn from that?
Yeah, so there's several things to be said here. One is, you're absolutely right, and I just want to underscore kind of your statement, because I think it's very important that the fund's view is that now is the time to rebuild fiscal buffers. And if you look at the relative performance of countries during the pandemic, if there's one thing that we've learned, is that countries that had fiscal space and used it fared much better than those that didn't have fiscal space. And so having fiscal space was very important, and we were going to have future crises, right? We just don't know when. So they will come, and so you want to be ready for them and have the space for them when they come. So it's very important what you said, Ben. In terms of the pivot, there's an interesting chart in chapter 1, which I would invite you to see. Unfortunately, I don't have here the PDF that I could show you, but it gives a picture of what is the kind of, the usual calculation that you can do about the primary deficit that stabilizes debt, and where is your current deficit, to kind of gauge this idea of how far you are from kind of having stable debt. And some countries are very close or at that. So actually, they don't need to pivot as much. For example, out of the top of my mind, I remember Australia is one of them. Some other countries are quite far. And so even the extent to which you need to do the pivot, which was a premise of your question, depends a lot across countries. Then finally, I don't think there was, and certainly there wasn't a box on this in terms of lessons. So I can't give you an answer like, hey, you should look at this. But one thing that ties with a theme that we saw earlier in the presentation is this issue that because of the political cycle in many countries, actually decisions to pivot, if there's a need, will be harder to make. But it's absolutely important that they are made kind of with a medium-term view.
Just picking up on that economic cycle, you've talked about the implications of that for fiscal policy. Getting the last couple of percent down in inflation towards targets going to be hard. Fiscal policy, markets putting high focus on that. Do you see much risk internationally that inflation targets might be revisited as some of the levers during the electoral term?
So as I said, we see risks as fairly balanced. So we're now focusing, and I think the markets and like the press, given the numbers, especially coming out of the US, the last few monthly prints have been higher than people expected. People are now really focusing on these higher inflation prints, but in our view, the risks are balanced, and we can actually could be returned to be surprised on the with inflation coming below expectations. So that's just a point to make, because we tend to over focus maybe on kind of the latest print. On the issue, which I think you're raising a very important issue that some central banks may be thinking about, which is to revisit the level that they're targeting. I think the fund has, a very cautious approach to policy credibility and building credibility in institutions. And when you communicate to markets and agents a certain policy goal, you have to be very mindful that if you're challenged to meet it, that you move the goalpost, because there's consequences in terms of how the public perceives then your effectiveness in terms of policy making. So that's always there, and I think it's something that central banks need to take in mind. One thing that, if just to close, this disinflation period that I started with, right? We had a chart where disinflation was stronger than what we thought. I think a lot of it, if you look across countries, a lot of it also comes down to policy credibility and the fact that agents, for example, in the US, long-term inflation expectations, even medium-term expectations didn't move almost, even though inflation was running really hot. And you got to think, why is that? Is because there was credibility that was built along, many years, and that decisions like the ones that we're talking about, especially in the context that we're talking about, could endanger. So I think that's always the trade-off, right? Like moving the goalpost, and of course it would be easier to meet it versus keeping the goalpost and affirming credibility around it.
I think we've got time for one more question, so I'll take it over here.
Thank you. Just elaborating on your question, I think, did I hear right that you were coming from the perspective that actually policymakers would change the target of central banks rather than central banks themselves changing their target? And so therefore that has implications for the credibility of the central bank, right? I mean, given the high levels of public debt, right, deflating our debt is kind of like quite a interesting proposition from a political perspective.
Yeah, so I think if that was what you're coming up, yeah, that's an even maybe clear cut, which is in countries where monetary policy is independent from governments, we find that actually independence of central banks is a major predictor or driver of actually meeting your target. So it's not right. So it's not just about the level of the target. Now we're talking about the independence of the central bank, kind of the institution of the central bank. It's very important for meeting the target for allowing inflation to be low and stable. And so in the IMF's view, that certainly is an important feature to keep.
That's I think most of us would agree. It would be interesting to see where the international politics plays out on that, to see whether that holds. It's going to be a challenging environment, as whether it be to deflate debt, whether it to be boost growth, etc. So definitely a challenging time ahead. Unfortunately, we've run out of time on there. So, but thank you very much, Rui. That's been really good. Thank you for coming to Wellington. It's you're talking through your the overall package of countries that you're doing with Australia already, New Zealand now, and then Japan. So quite a package of housing markets to look at there. Thank you to everybody for being here, and for those online, and for the questions online. For those of you up in Auckland, just a reminder: Rui will also present a special seminar in Auckland on Thursday this week. It's also more broadly, it's a bumper week for the Treasury guest lecture series, because on Wednesday we'll also hear from Professor Cass Sunstein from Harvard Law School on his concept of nudges and how to use thoughtful choice architecture to help us make better decisions. If you're interested, visit the Treasury website and register there, and check out the very exciting seminars. For those who participated in Dirk, sorry, I've forgotten Dirk's last name. Yeah, Pillett. He's just finalised his paper that went along with his seminar, and so I don't know if it's up already, but very shortly, in the next week, we'll be putting a link to that paper up on there as well. But once again, thank you to you, Rui, and I'd like to finish with a karakia, piki te kaha, piki te ora, piki te wairua, hui e, taiki e. Ka kite anō.